Hello and welcome to lesson number 4, in which I focus on silver. Silver has long been considered the poor man's gold, or gold's little brother, because historically it was money, but much less valuable than gold. According to Wikipedia, silver was far more common than gold as the monetary standard from 3000 BC until the late 19th century. The United States mandated a silver standard with the Mint and Coinage Act of 1792 and a value of silver of roughly 15 times that of gold. However, the silver standard officially ended under the Coinage Act in 1873, in which silver was demonetized. Figure 4.1 from sharelinks.com plots the gold-silver ratio dating back 300 years and includes my annotations. The gold-silver ratio had hovered around 15 consistently, reflecting the historic supply differential and often the legally mandated value between the two metals. Since the demonetization of silver under the Coinage Act of 1873, the ratio has ranged from 15 to over 100. It fell to as low as 15 at the end of historic peaks in the gold price and inflation. The low before 1970 was due to the gold price peg during the start of that inflationary period. Although silver is consumed like a commodity or base metal, its driving forces are most similar to gold. In terms of demand, that means investment demand. While gold demand is composed almost entirely of jewelry, investment demand, and central bank demand, silver's demand is mostly industrial, roughly half, jewelry, photography, and silverware. However, as is the case with gold, investment demand is what drives silver on the margin. In figures 4.2 and 4.3, we share screenshots of data from Metals Focus GFMS, courtesy of the Silver Institute. In recent years, the strongest gains in the silver price occurred in 2016, 2019, and 2020, which included the strongest investment in silver exchange-traded products. Last year, 2022, saw one of the biggest supply-demand imbalances in the market in its history, yet net investment in silver exchange-traded products declined at a record level. Figure 4.3 shows a screenshot of the supply and demand data from 2007 through 2016. The strongest gains in the silver price correspond with the strongest inventory builds in the exchange-traded products. The only year that was different was 2008. In addition, note the changes in the ETP inventories in 2013, 2014, and 2015. These were bad years for silver, despite huge supply-demand imbalances. Because investment demand is the major demand driver of the silver price, it should not be a surprise that historically silver is more tethered to gold than copper. Figure 4.4 plots the historical performance of gold, silver, and copper. Historically, silver has acted like a highly leveraged play on gold. It greatly outperformed gold during the two secular bull markets, in yellow, and underperformed badly during the two secular bear markets, 1980 to 2001 and 2011 to 2022. Silver has also followed gold more closely than copper on a shorter term and more cyclical basis. Consider the following examples. Copper performed reasonably well from the mid-1980s to the mid-1990s. It even retested its 1980 peak in 1989 and 1995. Gold trended down during this period, while silver by 1993 was trading around a 20-year low. Each market performed well in the early to mid-2000s, but gold and silver strongly outperformed copper from 2006 to 2011. The outlier in silver's history was the price increase in 1997 due to Warren Buffett's huge investment. Most recently, silver has remained strongly tied to gold. The vertical line shows the gold price peak in August of 2020. Copper surged higher after that into 2021 and remains well above its August 2020 price today. Copper's strength helped silver into 2021, but that aside, silver has corrected quite a bit alongside gold during that period when copper showed strength. In figure 4.5, we plot gold, silver, and the consumer price index to compare silver's performance around important breakouts in the gold price and rising inflation. The thick vertical marks the most important breakouts in gold, and the light vertical lines mark the other breakouts in gold. The biggest moves in silver occurred after the most important breakouts in gold. Breakouts in gold usually happen before and lead to breakouts in silver. Most notably, gold broke out first before silver in 1978, 2003, 2009, and 2019, and is about to do so again. Gold usually leads inflation, but gold also leads silver. The three most significant breakouts in gold and ensuing advances in silver occurred amid rising inflation. Here is how to think of the relationship between gold, silver, and inflation, and how silver might perform. Silver will outperform if gold breaks out to the upside and inflation rises. If gold breaks out to the upside, but in a deflationary and recessionary environment, then gold will outperform silver, at least until inflation begins to rise again. Silver is an industrial metal because industrial applications account for roughly half of its demand. But the reality is that silver trades almost exclusively as a leverage play on gold. History shows that greater industrial demand or a significant supply deficit will not materially move the silver price. When gold is in a secular bear market, silver is a complete afterthought and trades as such. However, when gold is in a secular bull market, which appears imminent, silver becomes considered a precious metal again and is valued as such over time. In Lesson 5, I will discuss the technical setups for gold and silver and potential outcomes over the years ahead. Thank you for tuning in.